This is a CBC podcast. If you have an iPad, iPhone, or iPod Touch, be sure to download the latest version of the updated CBC radio app. You can hear live streams and on-demand audio from more than 60 of CBC's most popular programs. Multitask on your device and still hear that great CBC sound. Find it at cbc.ca/iTunes.
Hello, I'm Matthew Lazenrider, and this is The Invisible Hand. This is a show about economics, and the invisible hand is a concept first put to paper by 18th century Scottish philosopher Adam Smith. He used it to describe the hidden forces at work in a free marketplace. Adam Smith thought of the invisible hand as a benevolent force, but today we're going to find out what happens when the invisible hand sets a trap. Today, the mysteries of moral hazard. Most economists like to look at people as rational creatures. We take the available information and make choices that suit our own interests. And when everyone plays by the rules, that self-interest can serve the common good. But sometimes the rules are a problem. If we're not careful when we write a contract or draft a law, we create what economists call moral hazard, a temptation to act against the common good. And when that happens, these hazards can lead to fraud, arson, murder, and global financial collapse. So it's simple, right? Just write ironclad contracts and loophole-proof laws. Not so fast. Today on The Invisible Hand, we'll find out how the same force that can make you burn down your failing business or shoot off your own foot could also be the magic ingredient for economic prosperity.
Moral hazard. To economists, a term to describe the tendency of people to take undue risks because the costs will be borne by someone else. Or as the Wall Street Journal once put it, the distortions introduced by the prospect of not having to pay for your sins.
To better understand the concept of moral hazard, the Invisible Hand players have put together this dramatic recreation. Meet Jerry Shirk. Jerry's got a good job. He's a soccer coach and a community volunteer, a family man.
Hello, Mrs. Peterson. Your garden's looking as beautiful as ever.
Oh, thank you, Jerry. You're too kind. Oh, and by the way, are we still on for checkers tonight?
You betcha, Mrs. Peterson. 8 o'clock like always. But right now, there's a slab of meatloaf with my name on it.
He doesn't know it, but he's about to fall into a very old economic trap.
Oh, Jerry, before you go inside, I think you forgot to lock your car.
Ha! No worries, Mrs. Peterson. I just bought theft insurance.
Jerry just gave us a textbook example of what economists call moral hazard. Here's how it works from an economist's point of view.
You know, insurers have known forever that when you give someone an insurance policy, their incentives change. In particular, they are no longer self-insuring. Someone else bears the risk. And so an insured person might take fewer precautions, might even tend to be more careless. For instance, if I have homeowners insurance, I may not worry so much about my house getting broken into, and I may not remember to lock my doors when I leave.
That's Steven Tomlinson. He teaches economics at the Acton School of Business in Austin, Texas. Steven is also a playwright. Moral hazards make up a big part of both his vocations. They're what adds human drama to economic equations. He says moral hazard, at its basic level, is part of what economists call an asymmetric information problem.
Asymmetric information means that one party to the transaction has better information than the other. Typically, the seller of a used car knows more about its value than the person who's trying to buy it. Typically, the person who's seeking insurance knows more about the risk than the company that's providing the insurance. So once I get the insurance, then suddenly my incentives are different, because I don't bear the full risk of my house getting broken into or my car getting totaled. I may be more likely to exert less effort to keep those losses from happening.
We'll hear more from our economist Steven Tomlinson in a few minutes. But what's important here is the role that thing called asymmetric information has in creating a moral hazard. In the case of our fictional friend Jerry Shirk, well, the insurance agent would never have signed him up if she knew what kind of irresponsible jerk Jerry would become. Let's pay another visit to Jerry. He's about to face another moral hazard, and it's time to see how he responds. He and his family have just returned from a camping trip to beautiful Salt Spring Island. It was a great holiday, but it ends on a sour note.
Dad, where's the TV?
Well,
Yeah, Dad, where's the computer?
My grandma's brooch! My grandma's brooch!
I guess we should have locked the doors before we went on holidays.
Don't be silly, Mikey. We got insurance for it. This is a good thing. Maybe we'll even sweeten up the pot a little bit.
What do you mean by that?
What I mean is, that 42-inch set was starting to look a little small. We tell the insurance guy it was a 52-inch set, and bingo! TV City.
I think your moral compass might be broken.
Thankfully, Jerry is not a real person. But enough real people act like Jerry Shirk that moral hazard is a real problem for insurance companies. First of all, they have to worry about that information imbalance, and then they have to worry about outright fraud, like the sort of thing Jerry was just suggesting. So insurance companies have to find ways to work around these pitfalls. Otherwise, they'd have so many claims, their costs would go up, and those costs would be passed along to you, their customers. One of the ways insurers try to relieve moral hazard is to make incentives that create better outcomes, and technology can play a role as well. For example, they can't know whether Jerry's going to lock his car, but they can give him a better rate on theft insurance if he gets a car alarm. They can't know if Jerry smokes in bed, but they can lower his fire insurance premiums if he puts sprinklers in his house. So technology and those little incentive carrots can help cover for Jerry's careless behavior. But they can't keep an eye on Jerry all the time to monitor his every move. And what about when the moral hazard goes beyond just carelessness? What if the temptation of an insurance payout is just too strong? After Jerry's house was burgled, he talked about padding out the claim on his insurance. That's when he took the plunge into the deep end of moral hazard. Here again is our economist, Steven Tomlinson.
There's also a view of moral hazard where actually people behave in a more exploitive, fraudulent way. When they have insurance, they may fake a robbery so that they can get money from the insurer because the insurer bears the risk.
Faking a robbery or a fire or an injury, it might seem pretty extreme. But it's time to take a trip to a place where the extreme became the everyday. The town is Vernon, Florida. But about 40 years ago, it became known as Nub City in the insurance industry. Vernon was once a thriving shipping town, but change came and history left Vernon in the economic backwater. By the 1950s, times were hard enough that people began to take drastic measures. Personal injury policies often pay out cash for the loss of a limb. The idea is that if you can't work in the short term or the long term, you have money to get by. But in the classic definition of moral hazard, we know that once someone is insured against a risk, they tend to be less careful about avoiding those risks. So if you're insured against the loss of your hand, and losing that hand will pay you more than your non-existent job in Vernon, what do? The answer wasn't pretty, but it was profitable. Pretty soon, self-amputation was a cottage industry in Vernon. Now, this was a town of just over 500 people. Over the course of a decade, insurance companies reported 50 cases of dismemberment claims. Investigators noted that the victims always seemed to lose the limbs they needed least. One insurance agent told a Florida newspaper about a few of his policyholders. One guy shot off his foot in a valiant defense of his chickens. There was the fellow who managed to lose 2 limbs during a strange incident with a rifle and a tractor. One client was in such a hurry he shot off his foot while aiming at a squirrel, just 12 hours after he took out his policy. Insurance companies were so alarmed at the pattern of claims, they hired investigator John J. Healy. He later wrote a book about his experiences. He wrote,
"To sit in your car on a sweltering summer evening on the main street of Nub City watching anywhere from 8 to a dozen amputees walking along the street. Gives the place a ghoulish, eerie atmosphere. I hope I never have to go into that town again and hear the same old familiar story. But deep down inside me, I know I will.
That is an excerpt from A Game of Wits by former insurance investigator John J. Healy. Perhaps his inner economist recognized the inevitability of it all. Moral hazard was built right into those insurance policies. To economists, the reason our character Jerry Shirk left his doors unlocked was the same reason the good people of Vernon started tallying up the worth of their limbs. Thanks to moral hazard, they didn't have to bear the full cost of their bad behavior. In a few minutes, we're going to hear what happens when moral hazard doesn't just trip up an individual or even a whole town, but an entire economy. I'm Matthew Lazenreiter. You're listening to The Invisible Hand on CBC Radio 1 and across North America on Sirius 159. There's no hazard involved in checking out our website, cbc.ca/The Invisible Hand. We've heard some pretty disturbing things can go on when people give in to the temptation of moral hazard. Today on the show, we're trying to figure out why insurance companies and economists don't just find a way to crack down, to eliminate moral hazard in every kind of contract or regulation. Remember, moral hazard happens when people take more risks than usual because someone else will have to carry the cost. They can be small risks like leaving your car unlocked because you know you're insured, or they can be something bigger, like, in our next example, something way bigger. The concept of moral hazard may have its roots in the insurance industry, but more recently the term has been popping up in conversations about politics.
This is America. How many of you people want to pay for your neighbor's mortgage that has an extra bathroom and can't pay their bills? Raise their hand.
That's Rick Santelli. He's an American financial analyst for the CNBC network, but he's best known for an on-air rant that sparked a political wildfire. Santelli was reporting live from the trading floor of an American futures exchange, and he was asked for his thoughts on whether the United States government should bail out homeowners who took on too much mortgage debt.
To see if we really want to subsidize the losers' mortgages, or would we like to at least buy cars and buy houses in foreclosure and give them to people that might have a chance to actually prosper down the road?
Santelli stirred the pot with his fiery language, and then one of the traders leaned in to give his 2 cents worth.
Are you listening?
How about we all stop paying our mortgage? It's a moral hazard.
Not to be outdone, commentator Santelli kicked it up another notch.
We're thinking of having a Chicago Tea Party in July. All you capitalists that want to show up to Lake Michigan, I'm going to start organizing.
In that instant, the Tea Party movement was born. It's now become a vocal force in American politics. Rick Santelli's complaint was this: if the government bails out homeowners who borrow recklessly, then homeowners have less of a reason to pay back their loans, because Uncle Sam will be there to catch them when they fall. That's one version of how moral hazard could have played a role in the continuing collapse after 2008. Now, there are a lot of politics involved in defining what role moral hazard might have played in the whole affair, and even about how many of the different players found themselves in moral hazard. It's a lively topic of debate among economists. So let's take a look at just some of the ways the economic principle of moral hazard could have sparked a global recession.
At the heart of the financial crisis was a thing called mortgage-backed paper. That's just a fancy way of saying bundles of mortgages. A small bank would take a risk lending money to a borrower. Then they'd sell that mortgage on to a bigger investor. According to many economists, the small banks were now in moral hazard. Because they were selling people's mortgages up the chain, they didn't bear the full risk. Lending standards loosened up. Someone looks like they're just barely scraping by? Give them a mortgage anyway! We can sell it to someone else. And if the person goes broke, the bank we sold the mortgage to is left holding the bag. But that's not the end of this story. The bigger bank would sell the mortgages to huge investors like Lehman Brothers, Fannie Mae, Freddie Mac, giant firms that buy pools of mortgages. Those firms would then sell them on to millions of investors all over the world. Once again, moral hazard. They passed the risk on to other people while everyone down the ladder pocketed some money. And as soon as the person at the bottom buckled, the entire Jenga tower of moral hazard collapsed in a big, awful pile known as the financial crisis. And then came the bailouts. The U.S. government said some of the banks involved were too big to fail. They stepped in to prop them up. And that, to many economists, adds one more layer. If big banks think someone will always have their back, that will change their behavior, and they're perpetually in moral hazard.
So, people like Rick Santelli, who we heard from earlier, were concerned about the moral hazard that the homeowners were in. What he didn't mention in his rant was the moral hazard that many economists believe was present in every step along the way. Some of them would look at this story and say that the incentives for borrowers and lenders to behave responsibly were twisted all out of whack. That means the trap of moral hazard was set on many different levels. Let's find out what Texas economist Steven Tomlinson has to say about that.
When you change people's incentives, they will respond in a predictable fashion. Now, this isn't to say that everyone in the story was behaving in an intentional, fraudulent, particularly greedy, excessive sort of way. Although after the fact, it's very easy to take any piece of that story and make it that if you want to. The people who made the loans, you might say, they were responding rationally to the incentives that are created by deposit insurance or by the knowledge that they were too big to fail or things like that. Or you could say they were willfully exploiting the ignorance and wishful thinking of people who wouldn't otherwise have access to credit. I think that it's only on a case-by-case basis that we're going to know what was in the hearts of the people who took part in the transactions that added up to the financial crisis. However, an economist would say, very predictably, that if you change the incentives of a lender by giving them deposit insurance protection or the reasonable expectation of a government bailout, that it changes the expected value of making loans that they wouldn't make if those floors weren't underneath their expected returns.
What Steven's saying there is that he can see moral hazard present in the roots of the 2008 financial crisis. For some, it was a trap, and they walked right in, like fictional buffoon Jerry Shirk. For others, it was an opportunity, and they knowingly took advantage of it, like the trigger-happy residents of Nub City, Florida. But if moral hazard can bring the global financial system to the brink of collapse, if moral hazard is such a challenge for the insurance industry and for the mortgage industry, why not write ironclad contracts and laws that wipe these tempting traps out altogether? Well, first of all, economists like Steven Tomlinson say, it's not that easy.
There's always the possibility that banks would want so much collateral or that co-insurance would become so onerous that all the efforts that we make to protect ourselves would ultimately shut the market down. That all the things that would be required to monitor and protect and deductibles and all of the tools that we use to manage moral hazard eventually become so cumbersome that the market just doesn't work anymore.
So that's the first reason economists say we can never eliminate all moral hazard. If we try, we risk eliminating the entire mortgage and insurance industry. Reason number two, some economists say a little moral hazard is actually good for the economy. To find out why, let's look at one place where taking a risk is all part of the cost of doing business. That is in the world of business startups and entrepreneurs. Statistics Canada says about 30% of small businesses fail in their first 5 years. So why would anyone go into business on their own?
From every job you create, that now goes into another family's pocket. That family can now buy a house. They can, become a part of society.
Paul Hecht is a Toronto entrepreneur. He's in real estate and has a website where he sells books and DVDs teaching other people how to get into the business.
Well, to me, it's really creating your own life on your own terms. So, it's pure performance. Whatever I do, I get rewarded, or if I don't do something, I don't get rewarded. that's really what entrepreneurship is. It offers, it might seem more risky, but on the other side, there's also, I believe, more reward.
As he says, starting your own business means balancing all of those tantalizing rewards with the less tantalizing risks. It was an equation that didn't always go Paul's way.
So I went to the grocery store one day. That's kind of when it hit me. Went into the grocery store, got some milk and eggs for the kids because we were going to make pancake breakfast, right? So I went in the grocery store and got to the till, handed the cashier my credit card, and it was declined. And that was my last credit card. We were done. It was all maxed. And so I walked out empty-handed. And I went home. As soon as I got in the door, my wife knew exactly what had happened. Daddy had nothing. He was empty-handed. And so at that point, we knew we were at the end. So here I was trying to go for financial freedom, ended up bankrupt.
So Paul's first attempt at entrepreneurship ended in bankruptcy. And that meant...
there's definitely setbacks. Your credit's definitely affected. And that goes on for 7 years. If you do get loans during that 7-year period, they're definitely at much higher interest rates. On housing, you have to put down more down payment. It's you can't be a director of a corporation.
We'll hear how Paul got through it in just a moment. But first, George Gia wants to weigh in. He teaches economics at the University of Prince Edward Island.
So my research is on personal bankruptcy law and entrepreneurship. So it is well known that opening up or maintaining a small business is very risky. However, that because we do have, corporate bankruptcy law or personal bankruptcy law that actually protects people from, ongoing loan or debt obligations. So when people are thinking about opening up a business, that when they go to the bank, they might think if it's easier for me to walk out of the office and say, hey, I don't owe you anything because I can file for bankruptcy and, basically protect myself from failure, and that I'm more likely to open up a business.
What George Gia is saying sounds like a classic case of moral hazard. In Canada, bankruptcy is a lot more forgiving than it is in a lot of other countries. That means entrepreneurs who fail aren't sentenced to debtor's prison or to a life of mandated poverty. George's research shows that the more lenient a country's bankruptcy laws, the more entrepreneurial its population. So why should we care about making it easier for people to open small startups? Why should we, as a society, take on part of their burden? Just ask George.
We estimate about 10% of people actually run small business, and they contribute to roughly 30% of GDP.
30%?
Yeah, that's the direct impact, and then the spillover might even be bigger. The very foundation of bankruptcy law was actually established to promote business undertakings. In this way, the moral hazard in this situation might actually be good for the economy.
At least a third of Canada's gross domestic product relies on people being able to start a business. We share the risk involved when entrepreneurs like Paul Hecht start up a real estate business, but we share the rewards as well. You remember Paul, the Toronto real estate investor and public speaker? The result of him being able to declare bankruptcy without too many dire consequences was that he was able to get back on his feet. On his website, the one where he sells his books and videos, he proudly declares that he went from bankrupt to millionaire. That story he shared about not being able to buy pancake fixins?
And that was my last credit card. We're done.
That was part of a video about his experience that he uses to inspire another generation of entrepreneurs. We'll give the final word today to economist and playwright Steven Tomlinson. What does this all say to him about the many dramas and mysteries of moral hazard?
It points out the complexity of this idea of moral hazard, that we would apply it in a case where we actually like what it's making people do. That an entrepreneur, if he or she faces the full downside of losing everything they have if their business doesn't pay off, they won't do it. They won't take the risk. And as a result, all this innovation that makes our society so prosperous might not otherwise happen. And so the possibility of bankruptcy changes the calculation for the entrepreneur. And the entrepreneur moves forward and builds their dream, goes full out, creates something new, and many of them fail, and the floor underneath it keeps them from being completely ruined. And those that succeed create enormous wealth that's shared across society. An economist would use the term moral hazard to describe how the entrepreneur's incentives change with bankruptcy in place. If you took away the bankruptcy possibility, then the classical insurance line of thought would say, good, we're making those entrepreneurs be fully accountable for all the potential loss they're creating. And yet, what's the loss to society if they don't take the risk? So the term moral hazard in a strict economic sense, in the sense of expected utility, calculating upside and downside, it's at play here. By lowering the risk to the entrepreneur, we make them do something that society gains from.
Lowering the risk for individuals so they can act in a way that society gains. And that, ultimately, is why many economists say you'd never really be able to get rid of moral hazard, as hazardous as it can be. If everyone is solely responsible all the time for everything they do, why would anyone do anything? You wouldn't be likely to drive a car if you had to pay all of the costs associated with an accident. Auto repairs, medical bills, legal fees, maybe even a telephone pole or two. So no moral hazard, no insurance. You wouldn't be likely to buy a house if you had to pay every penny today and assume every financial risk by yourself, so no moral hazard, no mortgage industry. And you wouldn't be as likely either to start up a business, employing others, keeping the Canadian economy going, if you had to risk your family's financial future forever. Under the influence of moral hazard, people leave their doors unlocked, shoot off their limbs, buy toxic mortgages and sell them to someone else. And oh yeah, keep a huge chunk of our country's economy running. That is why it could be hazardous to live without it. The magical moral hazard, letting you take a risk and letting someone else bear the cost. Thanks for navigating this hazardous economic terrain with us. We'll be back in 7 days, right here on CBC Radio 1 and Sirius 159. You can find us online at cbc.ca/The Invisible Hand. We'd love to hear your feedback on the show, which you can send to us at invisiblehand@cbc.ca. You can also follow us on Twitter at CBCTheHand. Our show is produced by Jeff Turner. Our economic consultant is Stephen Gordon. Our senior producer is Karen Burgess. And I'm Matthew Lazen-Riley.
Looking for more CBC podcasts? Go to cbc.ca/podcasting.